It's finally here, lower interest rates. We also have news on the housing market, retail sales, and manufacturing. Let's take a look. Before we begin, remember to like this video and subscribe for more economic updates. On Wednesday, Federal Reserve policymakers pleased a whole lot of people when they lowered the benchmark federal funds rate by 50 basis points. Outside of the emergency rate reductions initiated during the global health crisis, it's the first half-point rate cut by the central bank since 2008. The reduction lowers the Fed funds target rate from 5.25% to 5.5%, down to 4.75% to 5%. In its post-meeting statement, the Federal Open Market Committee suggested the extra-large rate cut was appropriate based on policymakers' assessment of the degree to which inflation is slowing and the labor market is loosening. Fed Chair Jerome Powell clarified the central bank's objectives at his news conference following the decision, saying, "We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation." As for where monetary policy may go from here, the Fed's updated summary of economic projections suggests another 50 basis point reduction before the year is out, a full percentage point cut next year, and another half-point cut in 2026. Elsewhere this week, on Tuesday, the National Association of Home Builders reported that its housing market index rose 2 points in September, climbing to a reading of 41 from 39 in July, the lowest measure of the year so far. Despite the result, which analysts attribute to an improvement in mortgage rates, it appears home builders remain a long way from feeling truly optimistic. The index, which gauges builder sentiment on a scale of 1 to 100, remains more than 20% below its historical average of 52, and well below the range of 75 to 84 that characterized the 2021 post-global health crisis housing boom. In another update on the real estate market this week, the National Association of Realtors reported on Thursday that sales of existing homes fell 2.5% month over month in August, to a seasonally adjusted annual rate of 3.86 million. That's the slowest pace since October 2023. Economists had expected sales of previously owned homes last month to come in at a slightly better 3.9 million units. Year over year, existing home sales were down 4.2% last month. However, in a statement, Lawrence Yun, the NAR's chief economist, suggested things may be looking up in the near term, saying, "Home sales were disappointing again in August, but the recent development of lower mortgage rates coupled with increasing inventory is a powerful combination that will provide the environment for sales to move higher in future months." In other news this week, the Census Bureau reported that retail sales ticked up by 1/10 of a percentage point in August. Although it's just a modest increase, economists were surprised to see sales rise at all, considering they surged a hefty 1.1% in July. Heading into this week, retail sales for August were projected to remain flat. Excluding autos, the figures weren't perceived as quite so positive. Although retail sales ex-autos also were up by 1/10 of a point, that's lower than the 4/10 of a point increase economists were expecting. Overall, however, analysts saw the August retail sales numbers as reasonably upbeat. Finally, some good news from the economy from its long-suffering manufacturing sector. On Monday, the New York Fed reported that the index derived from the bank's Empire State Manufacturing Survey rose 16 points this month to come in at a reading of 11.5. The number defied the expectations of economists who projected the index to land at -5. It's the first time since last November the index has come in above zero, which means it's the first time in nearly a year that expansion has been indicated in New York State's manufacturing sector. That's a wrap for now. See you again next week. This is Devlin Steele for Augusta Precious Metals signing out.